Hello, my name is Marijka, and today we're going to present to you the information you requested about Springsteen's operations for the month of July, year 2012. First, we will recommend whether you should use the standard or normal costing. Then we will explain to you the variances we calculated. And finally, we will evaluate the overall performance for the month of July. First, we recommend Springsteen to implement the standard costing system. This will allow the manager to have time to look into and investigate significant costs, only the significant costs. And this is considered management by exception. However, what is significant? Along with considering not only the costs and benefits of investigating, some guidelines that managers follow are the size of the variance, recurring variances, and favorable as well as unfavorable variances. As long as the operations are going along as planned, the budgeted amounts will be close to actual numbers. Two methods are used for standard cost setting: analysis of historical data and task analysis. One indicator of future historical data, one indicator of historical data of cost is historical data. One indicator of future costs, in task analysis, the emphasis shifts from what the product did in the past to what it should cost in the future. For standard setting, they should not rely solely on the managerial accountant. Many different people in different departments should be involved in standard cost setting. For example, in the production department, the production supervisor should be involved, and in the sales department, the sales manager should be involved. Now Hall will tell you about the material variances.
The direct material price variance is based on the purchase quantity. The veneer B, the actual price was 50 cents more per pound than the standard price. The bridge and the string for the beginner model was $1.50 more per unit than standard. And for the professional model, it was 50 cents more than the standard price. Overall, the company has an unfavorable direct material variance because they purchase supplies at a higher price than the standard price. For the direct material quantity variance, for rate A, they use less pounds than the standard quantity. And for rate B, they also use less pounds than standard. Overall, they use less ingredient than standard amounts, which create a favorable direct material quantity variance. Yumiko will talk about the direct labor variance.
According to our research, direct labor rate variance resulted in favorable. This is due to the actual rate being lower than the standard rate. As for direct labor efficiency, variance was also favorable for the similar reason. The actual hours used in production were less than the standard, which also created an overall favorable variance. And now Esteban will interpret the variances.
The price of direct material variance depends on the purchase practice of purchase manager. In this case, they purchase material for expensive price but at good quality, which is why they use less of it and create a favorable quantity variances. If they bought cheaper material, they will probably have to use more of it, which will also create more hours needed for direct labor, which will probably create unfavorable direct labor variances. To lower the cost of material, we can still negotiate with other vendors but try to keep the same quality to keep our other favorable variances. Although we have favorable variances for direct material, that is not always a good thing. Remember, the company allows 1 pound of waste for producing 1 product unit, and the company or purchasing manager purchase expensive supplies that create direct material quantity variances favorable. Also, the standard labor rate was set too high that led the direct labor price variances favorable. Together created a labor efficiency favorable. This can explain that the budget was set too broad and too easy to achieve. Furthermore, because the actual wage is lower than the standard rate, that might create a higher employee turnover. Next, Lorena is gonna explain the July performance.
In the month of July, they had sales of 444 guitars, which was an 11% decrease from 2011. Springsteen should improve their profit margin in the following months. Management should perform frequent reviews, and the standard cost need to be revised often. They should review it because the standard costing focuses on cost minimization, rather than the increasing product quality or customer service. This concludes our analysis of Springsteen's 2012 July performance.